Our classroom stock portfolio of high-yield, dividend-paying companies now has an annual return of 35.73%, and it's beating the S&P 500 since the portfolio started. And our dividend-growth stock portfolio has an annual return of 22.59%. But our best performing portfolio so far has been our technology portfolio, which is an annualized return of 54.6%. It has only been in existence since April of this year, though, so its return will likely fluctuate a lot, and it's very volatile. And like in last week's video, later in this video, I'll discuss ways to potentially boost the returns of our stock portfolios, but it will require giving up some portfolio diversification. This week, the stock market was up a lot in anticipation of easing regulation from the new administration next year, including more mergers and acquisitions, M&A activity, which should help our investment banks such as Goldman Sachs, Morgan Stanley, and Bank of New York Mellon, all of which are already up 90 to 100% for our dividend growth portfolio. In addition, the Fed cut interest rates by a quarter point again. Next Wednesday, a key inflation report will come out and will go a long way to determining if we have further rate cuts. As for next year, we'll have to wait to see if the proposed tariffs are put in effect and how they affect inflation. As we saw last week, some of our stocks will flourish under the new administration, but not all of them will. So I foresee some portfolio adjustments forthcoming. So what is this slide showing? It's showing the portfolio value over time for our main portfolio, which invests almost exclusively in dividend growth stocks. As a class project, in 2022, we started investing $12.50 each week into the portfolio, and it's now worth over $2,654 after 149 weeks. Each week we take that deposit and split it up to buy 10 different dividend-paying stocks, so we are buying fractional shares of stock. Each week we re-rate the stocks, so the list of top stocks fluctuates from week to week. And in August of last year, we started a second portfolio, this time investing in high-yield dividend-paying stocks. The tan line on the chart shows what the portfolio value would be if we'd instead put the money into a savings account. In our first year, 2022, stocks did not do well, and neither did bonds. As you can see, our portfolio had overall losses where the blue line falls below the tan savings account line. But the power of compounding is working in our favor as the portfolio really took off in November of 2023. I'll also update our tech stock portfolio later in the video, which has only existed since April of this year, but has been the best performing portfolio over that time. But like I said, with extreme volatility. And for those who have been asking, I put the dividend growth stock portfolio and the high yield stock portfolio on our site, which is beatthestockmarket.com. Hi, Professor Rex here, and happy Veterans Day tomorrow to my fellow veterans. If you're new to my channel, I teach college accounting, and I often show my students how to use the accounting concepts I teach to pick stocks because it gets the attention of my students and keeps them engaged. To show them accounting concepts in action, starting in 2022, we started a class project in which each Monday I invest actual real-world money, $12.50 per week, which is roughly the equivalent of $50 each month, into 10 different dividend-paying stocks. And because those original students are no longer in my class, I decided to make this video series to let them know how our portfolio is doing. Also, viewers can use our progress as inspiration for their savings goal and get ideas of company names that they can do their own research on. There are timestamp links in the description of the video in case you just want to jump to the list of stocks we bought last week, or the list of our best performers, or any other section of the video. In 2022, the year we started the portfolio, the market did not perform well, but because I don't believe in trying to time the market, we kept buying each week at what turned out to be great prices. Then in 2023, stocks took off. Currently, the portfolio's value is over $2,654. The portfolio's return has been 22.59% per year. Last year, the portfolio's return was 28.6%, which beat the market, which beat the S&P 500. And in the preceding year, the portfolio once again beat the market. So in this video, we talk a lot about our dividend growth portfolio and our newer high yield portfolio, which is geared more towards those nearing retirement. The table at the bottom of this slide shows the portfolio comparison when both portfolios existed. Remember, the dividend growth portfolio was started about 20 months earlier than the high yield portfolio. The high yield portfolio was started in August of 2023, and the annualized return so far is 35.73%, which is surprisingly higher than our dividend growth stock portfolio, which has an annualized return of 25.29% over the same time period. I would expect that the dividend growth portfolio would have the higher return over the long run, especially since the high yield portfolio has 0 tech stocks so far, but time will tell. If an investor was solely investing in the high yield portfolio, I would think about supplementing it with some tech stocks for additional diversification. On our website, we have ideas for technology-focused investments that provide income ranging from dividend growth stocks to closed-end funds and ETFs. Now remember, the high yield portfolio has only existence for nearly 15 months, so its annual return will likely jump up or down to a greater extent than the return of our dividend growth portfolio's return. This slide shows the cumulative growth of the dividends we've received in our dividend growth stock portfolio. Our dividends for the latest month increased 54% over the same month a year ago, and our dividends for the latest quarter increased 130% over the same quarter a year ago. The graph shows how quickly the dividends are growing and is a great example of the power of compound growth. Albert Einstein is widely rumored to have called compound growth the most powerful force in the universe. So why do we mainly invest in, only invest in dividend-paying stocks in our two main dividend portfolios? The first reason we stick with dividend-paying stocks for our dividend strategies is, according to a Hartford study, over the past 50 years, dividend-paying stocks vastly outperform non-dividend-paying stocks. The total return for dividend-paying stocks has been 9.17% per year, but for non-dividend-paying stocks, average return has been much lower at 4.27%. The study is updated each year, so go check out the source link that I included at the bottom of the screen. Morningstar also recently released a report that went all the way back to 1927 and came up with the same conclusion. Dividend-paying stocks have a higher return and less volatility than non-dividend-paying stocks. Now, that second point about having less volatility is probably even more important than the fact that dividend-paying stocks have a higher return. So why is a lower amount of volatility so important? Well, it's much easier to stick with a less volatile investing strategy. The more volatile a strategy is, the more likely you are to panic and sell at the wrong time. A good example is our technology portfolio, which we recently started. 2 weeks ago, it just got crushed. And a lot of people who were following that portfolio might just panic and sell at that time. But now, last week, it was by far our best performing portfolio, up over 6% in a week alone. So it's kind of hard to stick with really volatile strategies for some people. So why are dividend-paying stocks less volatile on average? Because most dividend-paying companies are making a profit, which is why they have excess cash to pay back to investors. As you can see on the screen, risk and volatility of dividend-paying stocks as measured by beta and standard deviation tend to be much lower for dividend-paying stocks, and that's a good thing. And finally, the study also showed that the best performing stocks are dividend-paying stocks that increase their dividends, which is why our classroom portfolio for the two dividend portfolios only invests in dividend-paying stocks that have increased their dividend recently. BlackRock recently released a report showing that $10,000 invested in companies that grow their dividends, in other words, increase their dividends, and companies that initiate a dividend, in other words, they start paying a dividend for the first time, grew to $2.6 million. Versus $1.6 million for the S&P 500, a difference of 62.5%. Now, the S&P 500 does include some dividend-paying stocks and some non-dividend-paying stocks. So a better comparison is to compare versus the dividend-payers versus the non-dividend-payers. So that same $10,000 invested into non-dividend-paying stocks only grew to $1.2 million. So stocks that raised their dividends or started paying a dividend beat the stocks that did not pay dividends at all by 116.7%. Now, the holy grail of dividend investing is having a stock portfolio that produces two things. One, a growing stream of income that produces enough income to cover your expenses, plus extra cash to cover travel, vacations, luxury purchases, etc. And two, also produces a growing stream of income that also grows faster than the rate of inflation. And dividend-paying stocks historically increase their dividends significantly higher than the rate of inflation. It means that quality dividend-paying stocks can provide a growing income stream for a lifetime. Now, this is in contrast to bonds, which do not raise their payments to bondholders. So here are two examples of stocks growing their dividend payouts over the years. The first stock is Broadcom. I bought Broadcom, a chip maker, in 2020, just 4 years ago, for my taxable account. At the time, its yield was 5.01%, meaning for every $100 I had invested in the stock, I would receive $5.01 every year. The company has quickly grown the dividend to the point where the yield based on my original investment is now 8.21%. And I expect Broadcom in November to likely increase their dividend yet again. Of course, investors buying the stock now are not going to get that high of a yield because the stock's price has risen so much. That's why it's important to invest early and be patient. And I fully expect Broadcom to continue to increase its dividends well in the future, like this quarter, as I just mentioned. And if not, that's why we have constructed a diversified portfolio. This is the power of investing in a quality dividend growth company. My second example of a high quality company with a history of raising its dividends is Home Depot, which I believe is going to be reporting their quarterly reports next week. Or I should say this week. In 2003, when I was attending college, I had started a dividend stock portfolio for the investment newsletter that I had started at the time, and Home Depot was recommended for that portfolio and is still in the portfolio today. At the time, its yield was a low 0.83%, meaning for every $100 I invested in the stock, I would receive only 83 cents per year. Seemingly not much to get excited about. But over the years, Home Depot has grown the dividend to the point where the yield based on the original investment is now 31.1%. And like Broadcom, while there are no guarantees, I fully expect Home Depot to continue to grow its dividend well in the future. Of course, investors buying the stock now are not going to get that high of a yield because the stock's price has risen. Again, that's why it's important to buy early and be patient. Now remember, stocks historically have a higher return than bonds and are also riskier than bonds, but you certainly will not find a bond that pays anywhere close to the yields on the original investment that these two stocks are paying. And bonds don't increase their payouts to investors like stocks can and often do. Now we got some new numbers this video for this slide. So another reason to own dividend-paying stocks is for the potential to generate up to $126,700 of tax-free income each year if you are married and filing jointly. Remember, the ultimate goal of dividend investing is growing your portfolio to a point where it generates enough income each year to live off the dividends. And because companies historically increase their dividends above the rate of inflation, you have the ultimate income stream that not only covers your expenses, but grows over time. And if you're married and filing jointly, you can make up to $126,700 in qualified dividend income and pay zero federal tax on those dividends if you have no other income. This is perfect for retirees. If you're single, that amount is $63,350 for 2025. Those amounts usually increase each year, and they just increased, as their standard deduction increases and tax brackets are adjusted. So how are those amounts calculated? First, you find the 0% tax bracket for long-term capital gains, and then find the standard deduction, which can be located in IRS Publication 505. As you can see, for 2025, the standard deduction was just increased, and meaning that you can potentially earn even more tax-free income from qualified dividends than you could in 2024. Then the final step is to take the 0% capital gains amount and add it to the standard deduction, which means we get a final amount of $126,700 a married couple filing jointly could generate an income from qualified dividends that would be federally tax-free. So why did we choose to start investing in our model stock portfolio with only $12.50 per week, which is essentially the same as $25 per paycheck? I personally am investing a lot more than that in these dividend strategies, but for our classroom model portfolios, the main reason we started with a low weekly investment amount is because I wanted to show my accounting students that you don't need much to build a diversified stock portfolio. In fact, when I was only making $11,000 per year as an enlisted member of the military, I started my investing journey with only $25 per paycheck. In other words, the equivalent of $12.50 per week. And because my brokerage account, Fidelity, allows me to buy as little as $1 per stock, we can quickly and easily create a diversified stock portfolio with little money. Originally, I invested $25 per paycheck into the Dividend-Growth stock portfolio, but found the process to be so fun that I split it up and now invest $12.50 every week. And we boost the contribution once per year by the amount of inflation to replicate the fact that people's paychecks usually increase at least by the amount of inflation. So in other words, when you get a raise, you should increase your savings rate and your investment rate. By the way, I also invest in these same stocks in my retirement account and my taxable brokerage account. The research we discuss in class is the same research I use for myself. Another reason I started with a low investment amount was because one day I was wondering how much a young person, in this case a 17-year-old, needed to invest per week to accumulate $1 million at retirement. And it turns out it's only $11.74 per week. Of course, since most people's annual salary increases each year by the amount of inflation at the very least, I assume the contributions would increase by 3% each year, which is around the historical rate of inflation. That means in the second year, it's assumed that the person invests an additional 35 cents per week for a total of $12.09 per week instead of the original $11.74 per week. For our classroom dividend-growth stock portfolio, in year 2, we boosted the weekly investment 82 cents for a total of $13.32 per week. In year 3, inflation wasn't as high, so we boosted the weekly investment by only 49 cents for a total of $13.81 per week. And at the end of this year, I think inflation will be even lower than last year. But we'll see what happens in 2025. A very popular exchange-traded fund, ETF, that only holds dividend stocks is called the Schwab U.S. Dividend Equity ETF, ticker symbol SCHD. SCHD is a large holding in my personal account, so I've been tracking SCHD's performance closely with our 2 dividend-paying stock portfolios. As of today, our dividend-growth classroom stock portfolio's annual return is 22.59%. If we'd instead invested the same exact amounts into SCHD on the same days, the portfolio's return would only be 13.75% per year, a difference of 64%. Our high yield portfolio is also outperforming SCHD, but by an even larger amount. Obviously, there's no guarantee that our portfolio will keep outperforming SCHD at such a high rate, but I've been gradually selling off my personal SCHD holdings and reinvesting in our 2 dividend-paying classroom stock portfolios. I also prefer our actively managed classroom stock portfolio strategy rather than SCHD's purely algorithmic approach where no one is overseeing the stock selection. SCHD has at times, had large positions in stocks I consider to be value traps. Now this slide shows our best performing stocks based on when they were initially purchased. This includes all 4 of our portfolios, but as you can see in the upper right, the dividend-growth stock portfolio was started much earlier than our other portfolios, which means the stocks in the portfolio have had much more time to see their prices rise. Therefore, this list of best performing stocks thus far will be dominated by our dividend-growth stock portfolio, at least for the time being. For example, our tech stock portfolio has been our best performing portfolio on an annual basis so far, but because it has only existed since April of this year, none of that portfolio's stocks have made this list yet. Of our 2 dividend portfolios, our best performing portfolio thus far on a per year basis is the high yield portfolio. But it only has 1 stock on the list so far because the portfolio was started 20 months after the dividend growth portfolio. It also holds far fewer stocks than our dividend growth portfolio. Now stocks in yellow, Evercore, F&G Annuities, and Repositrac have been sold. So our best performing stock so far has been Evercore, which we sold recently. It provided us with a 252.9% gain in a little over 2 years. Broadcom, a chip maker, remains at number 2 with a 230.5% total return since its initial purchase. Broadcom, Evercore, and Nvidia all have total returns over 200%, which means the initial investment has tripled. So far, 3 stocks have tripled and 5 stocks have doubled their initial investment, with Repositrac and Goldman Sachs barely missing that mark. The fastest risers that are still in the portfolio are Nvidia in our technology themed portfolio, with a total return of a 206.6% in 10 months, and Tapestry with a 69.8% gain in 13 months. Tapestry is in our this is an error right here. Tapestry, this should say the high yield stock portfolio, and Carlyle is actually in our dividend growth portfolio. Sorry about that mistake. And remember that total return includes both the dividends the company has paid as well as the increase in the stock price. Now this slide shows our best performing dividend stocks last week for the dividend growth portfolio. It does not include dividends that might have been paid last week. Now this week we can only fit in the stocks that saw their stocks rise 10% or more. That's how good of a week we had. And even then, the chart isn't very readable. The best performers last week were Worthington Steel with a 23.2% gain, McKesson with a 16.5% gain, and with a 13% gain, we had Atmos Filtration, Goldman Sachs, Finia, Ingredion, and Perdoceo Education Corp. Now, a lot of these companies that did really well this week, like Worthington Steel, are small cap stocks. Small cap stocks shot up the most last week. This slide shows our best performing stocks last week for our high yield stock portfolio, which is far fewer holdings than our dividend growth portfolio. The best performers were Goldman Sachs, Tapestry, Kinder Morgan, EOG Resources, Morgan Stanley, PNC Financial, M&T Bank, and HF Sinclair. So a lot of financials did really well last week. And this slide shows our best performing technology stocks last week for our tech stock portfolio. The best performers were EPAM Systems at 23.4%. And then coming at 10% or more were Marvell Technologies, NICE, Shopify, Globant. And then 9% we got Salesforce and NVIDIA, followed closely by CrowdStrike. Before we look at the 10 stocks we bought this week, here are the dividend-paying stocks we bought a year ago, along with their total returns, which of course includes dividends. Stocks in yellow, like Lowe's and Fidelity Info Services, have been sold. On the left side of the screen are the 10 dividend growth stocks we bought about a year ago. Stocks in yellow, like I said, have been sold. American Express has been the best performer so far with a 90.7% total return in a year. The average return of the 10 dividend growth stocks we bought a year ago is 37.65%, with 3 stocks being held for less than a year because they were sold. The annualized returns of all 10 dividend growth purchases is 40.69%. On the right side of the slide are the 8 purchases we made for our high yield stock portfolio. Now that portfolio utilizes 2 different strategies, and the strategies often overlap, meaning we often make 2 purchases of the same stock. As you can see, we bought Fidelity National Information Services twice, once for each of the 2 strategies. The average return of the high yield stock purchases we bought a year ago is 35.94%, despite 4 of the purchases not being held for the full year. The annualized returns of all the high yield purchases is 49.14%. Obviously, our purchases won't continue that high rate of return, but it's a great start for this portfolio. Here's a usual disclaimer. This presentation is for informational purposes only and is not a recommendation to buy or sell securities or engage in any investment activity. It's all well and fine to get investment ideas from others, but you always need to do your own research. So on Monday, we sold Lowe's and Hershey's for our dividend growth stock portfolio, and we sold Cloudflare for our tech stock portfolio. We sold Lowe's for an average total return of 38.1%, and it was held for a year. Hershey did not do nearly as well, as we almost broke even with a 0.6% loss. Fortunately, we had invested 4 times the amount in Lowe's as we had in Hershey. Cloudflare at the bottom of the screen was sold for our tech portfolio, providing us with an 18.3% return in 5 months. That's an annualized return of 49.1% using Excel's rate function. Now let's talk about the dividend growth stocks we bought last Monday. So here are my ratings for the top 15 dividend-paying stocks this past week. But remember, we only buy 10 per week. We purchased the first 10 stocks on the list that are not in the yellow highlight. So in other words, we do not buy more of Visa, Microsoft, MasterCard, and Allegiant. Stocks in yellow have already grown to be 4% or more of the portfolio, so we did not invest more in them this last week because we want to build a more diversified, less risky portfolio. 2 of our favorites, Visa and MasterCard, made the list again, but each already comprised 4% of the portfolio, so we didn't buy any more of those. And like I said, same goes for Microsoft and Allegiant. Remember, we use many criteria to filter stocks, and if they are hovering at a certain required level, they can make the list one week and then drop off completely the next week based on a small movement of that metric. Examples of criteria used to filter out stocks include required margin of safety and consensus earnings growth estimates over the next 12 months, which changes frequently. So each week, remember, we buy 10 stocks, and since we are investing such a small amount each week, it means we are buying fractional shares in our Fidelity brokerage account. And for those that have asked, we do not automatically reinvest dividends into the same stock from which the dividend was paid. Instead, each week when we are buying the 10 stocks as shown on this slide, we combine the weekly deposit with the dividends that have been paid that week and are sitting in the account as cash. We then take that combined total and split it amongst the 10 stocks that we are purchasing that week. And if we sold a stock or 2, we also take those proceeds and add it into that amount. In other words, we reinvest dividends weekly into the 10 stocks that we are purchasing that week. Now, for the sake of convenience, there's nothing wrong with simply turning on your broker's auto reinvest feature, but I think it's more ideal to reinvest in our top stocks each week instead of potentially reinvesting in a stock that is fairly valued as opposed to undervalued. The table on this slide includes a company's sub-industry, how undervalued they are according to our research, their risk rating, quality grade, and dividend yield. The most undervalued stocks last week appeared to be Applied Materials, Lam Research, Huntington Ingalls, Nike, Qualcomm, and PNC Financial. Remember, all these stocks pay a dividend and have recently increased their dividends, and our methodology used here indicates that they are likely to continue to raise dividends. Therefore, this is a dividend growth strategy. The stocks with the highest yields were, in order, Lyondell, PNC Financial, Huntington Ingalls, and Qualcomm. Now remember, this dividend growth stock portfolio is in a brokerage account separate from my regular brokerage accounts to make tracking this portfolio easier. So in my other brokerage accounts, I'm also investing these dividend growth stocks and the high yield stocks in the next few slides. This week I purchased over $2,900 of the stocks from dividend growth, high yield, and the tech portfolio as I reinvest dividends and gradually transfer out of my main dividend ETF and buy these stocks instead. But I'm also trying to tweak the buying strategy a bit to see if I can boost returns, and I'll share the results with you as I gather data. On this slide, I want to show the components to our quality grade. Quality-wise, we only invest in stocks rated B- or better for this portfolio for 90% of our purchases. The other 10% so far have been invested in smaller, under-the-radar companies that have recently started paying a dividend. Those under-the-radar dividend-paying stocks tend to be riskier, like F&G annuities, which did really well, and Repositrac, because they are smaller companies. But studies have shown they historically beat the market averages by a significant amount. We did not buy any under-the-radar dividend payers last week. All the stocks we bought last week qualify as high quality and are dividend growth stocks, which means they have a history of substantially raising the dividends that they pay to their shareholders. Risk is the first quality component, which we mentioned on the previous slide. The next quality component is competitive advantage. Obviously, the more competitive advantages a company has, the better investment candidate they are. The next quality component attempts to evaluate the company's management. Our evaluation includes both management's use of capital and general decision making, but also our research dives deep into accounting data to look for red flags in the company's accounting practices, as well as the quality or reliability of their reported profits. And finally, the last quality component is financial health. If you're looking for lower risk stocks, I would suggest looking at Microsoft, West Pharmaceuticals, and Nike. Remember that the risk rating is comparing these stocks to other stocks, not to other investments like bonds or CDs. The companies earning the highest financial health ratings are Applied Materials, Thermo Fisher, Visa, Microsoft, and MasterCard. Now let's look at the dividend growth grades of the companies. Remember, historically, the best performing stocks are those that both pay a dividend and have grown their dividend recently. As you can see under the grade called Grade for Recent Dividend Growth and Current Yield, the stocks with the best combination of dividend growth and a higher yield are Lam Research, Lyondell, and PNC Financial. All these earned an A- or better grade. Ideally, you want a higher dividend, high recent dividend growth, and the best potential for future dividend growth, but that's not the way it usually works. Companies that are already paying out higher dividends rarely have the greatest potential for the greatest growth in those dividends. In our list, as you can see from the last grade called Dividend Growth Potential, the companies in the best position to increase their dividends substantially are Applied Materials, Lam Research, Thermo Fisher, Visa, Microsoft, MasterCard, West Pharmaceuticals, McKesson, and KLA-Tencor. They earned a B+ or better grade. The companies with the best combination of recent dividend increases, current yield, and potential of future dividend increases are Applied Materials, Lam Research, and McKesson, having earned an A or B grade for both ratings. Here are trade confirmations from last Monday for the dividend growth stock portfolio. We took the weekly deposit plus any dividends we have recently received, plus the proceeds from the two stocks we sold, and those were Lowe's and Hershey, as you can see in green. And then we reinvested in the top 10 stocks in our buy list for the week, as long as they don't have a portfolio allocation of 4% or greater. And of course, if there's any dividends that were sitting in cash, we reinvested that into these 10 stocks too. Sometimes instead of dividing evenly across all 10 stocks, I try to invest a bit more into the high-ranked stocks, but this week I split up the investments as evenly as I could. Now let's talk about ways to potentially increase the return of our dividend growth portfolio. For those that are okay with giving up some portfolio diversification, I believe there are 4 potential ways to boost a portfolio's return. Each week we buy 10 different dividend-paying stocks ranked 1 through 10. On average, the stocks in positions 1 through 5 outperform the stocks in positions 6 through 10. Therefore, the first way to potentially boost portfolio returns is to buy only the stocks in positions 1 through 5. However, the downside is this reduces portfolio diversification, but some investors are comfortable with a more concentrated portfolio. So far, investing in only stocks ranked 1 through 5 would have improved annual returns 55.9%, but I prefer a more diversified portfolio since the goal of my dividend portfolio is to live off the dividends. Option number 2, don't limit individual portfolio holdings to 4% of the portfolio's total value. Normally, if a stock's allocation in the portfolio is 4% or greater, I won't purchase more of that stock. This technique reduces the portfolio's risk by ensuring the portfolio does not become heavily weighted in 1 or 2 stocks. I purposely created this portfolio so it would be very diversified because the ultimate goal of dividend investing is to have your dividends cover all of your expenses, plus generate extra income for vacations, travel, etc. I'm a conservative investor, and I'm personally investing a lot in these dividend portfolios, so I want to make sure the portfolio is not only well diversified between sectors, but also between industries and even sub-industries. That way, when the inevitable dividend cut happens, it doesn't affect one's cash flow in a major way. However, an investor who has a higher risk tolerance and therefore doesn't mind a more concentrated portfolio might try removing the 4% limit in an attempt to boost the portfolio's returns, especially if the company is in the top 5 of that week's ranking, as mentioned in the first bullet point. So far, not limiting individual stock positions to 4% of the portfolio would have improved the portfolio's returns by 21.9%. But again, I personally prefer a more diversified portfolio. Number 3, the under-the-radar dividend payers, despite having some incredible performers like F&G Annuities, 119% gain in 12 months, and Repositrack's 97% gain in the same time frame. On average, they have not performed quite as well as the dividend-growers in the portfolio, except for last week. Last week they did really well. So skipping the under-the-radar dividend payers is an option to try to boost portfolio return. One possible reason these stocks haven't done quite as well as the diversified growers is because many of the under-the-radar stocks are very small companies, and small stocks have not performed as well in recent years. Like the previous strategies, this method reduces portfolio diversification. And number 4, you could potentially sell when a stock is fairly valued, even if dividend and quality metrics are excellent. Now, we don't sell often in the portfolio and tend to only sell if the company cuts a dividend or the stock appears to be overvalued, or the company's dividend and quality metrics fall out of the top 50%. In other words, if a stock appears to be fairly valued, but the dividend and quality metrics are still good, we usually will not sell the stock just because it's fairly valued. But if you have your own valuation methodology and it signals that the stock is fairly valued or even overvalued, you might try selling at that time and reinvesting in that week's 10 stocks that we are buying. The downside would be higher turnover, but this could boost your portfolio's returns by not holding onto fairly valued stocks. If you try this, I'd be very interested to hear your results. Of course, this 4th strategy is the most difficult to implement because you have to implement your own valuation methodology. But some people use really simple valuation methodologies like the PE ratio. For those looking for a less hands-on approach, let's talk about some options to potentially simplify things. For our model portfolios, we invest weekly, but there's no hard and set rule that says to do that. Most people invest with every paycheck, meaning that most people have funds taken out of their paycheck, which is usually every other week, and it's automatically invested in their 401k. When I started our dividend growth stock portfolio, I originally invested $25 every other week instead of $12.50 every week. I only switched from every other week to weekly because I found the process to be fun. The advantage of investing every week as opposed to every other week or monthly is you get more diversification in your portfolio. So if one doesn't mind less diversification in their portfolio, option 1 is to invest every other week or monthly instead of weekly. Option 2 is to just buy the high quality stocks, meaning those with a quality rating of B- or better, and hold forever. Over time, some will turn out to be clunkers, but they will just become very small parts of your portfolio as you let your winners run. On this slide, we're looking at stocks that have raised their dividends recently. The holy grail of investing in dividend-paying stocks, as I said before, is to have the portfolio generate enough dividends to cover your annual expenses, a level I've reached despite being on a teacher salary. Historically, dividend-paying companies raise their dividends by 5 to 6% per year, which is above the historical rate of inflation. This means a stock portfolio can produce the ultimate passive income stream, that being one that increases each year above the rate of inflation. Now this week, Carrot Packaging raises dividend for the 4th time in 5 quarters, which is the most I've ever seen. The company has also paid a special dividend 3 times in the last 2 years. A special dividend is a one-time payment in addition to the regular dividend. The company is an under-the-radar dividend payer with high risk, so unfortunately I've not invested heavily in that stock. Other stocks in our portfolios increasing their dividends this week were KLA 10 Core with a 17.2% increase and Evergy with a 3.9% increase. The last 22 dividend increases for the portfolio have an average of 11.6%. Now let's talk about stock splits. Last week, Entergy Corporation, the last one on the list, and it's part of our high yield portfolio and it currently has a total return of 60.7% so far for us, announced it will split its stock 2-for-1 effective in December. So this slide shows stocks in our portfolios that have chosen to split their stocks. Since we keep track of every individual purchase in Excel, it's important that we have this slide to remind us to go back and adjust the purchase price, shares held, and dividends per share that we receive once the stock split has occurred. Here's a look at the 10 stocks that make up the largest portion of the dividend growth portfolio as of Friday after the market closed. Visa jumped from number 5 to number 1. Remember, our goal is to build a more conservative and diversified portfolio by limiting the amount we invest into one single company. Aggressive investors might not want to limit the investment into any one stock, but I'm a conservative investor, therefore we temporarily stop investing in a company if they make up more than 4% of the portfolio. This leads to a less risky, more diversified portfolio. It's true that our portfolio's returns would likely be higher if we only invest in our top 10 stocks regardless of the size of the stock's portfolio allocation, but that also creates a more concentrated and more volatile portfolio, and many investors cannot psychologically stick with a volatile portfolio. Volatility often causes investors to panic and sell at the worst time possible. Our portfolio holdings are now at 99. The highest was about 103, I believe. So far, a portfolio holding of 100 seems to be the natural limit for the portfolio, as there are only so many quality dividend-paying companies that are trading at a discount. So I don't need to worry about getting to like 1,000 stocks or anything like that in this portfolio. That might seem like a large number of companies to keep track of, but the spreadsheet we have developed for tracking the companies makes it obvious when to sell a company once we download company financial information and accounting information into the spreadsheet, which we do at least weekly, but doesn't take that much time. The thing that did take a lot of time was creating the complicated spreadsheet. Now let's talk about our high yield dividend paying stock portfolio. I have had several older students who are closer to retirement take my classes. They are more interested in stocks with higher dividend yields and asked to start a portfolio using a strategy featuring stocks with higher yields than the stocks in our dividend growth portfolio. So in August of last year, we started investing $12.50 each week into a separate portfolio, and we buy stocks with higher yields, like 3% or more usually. And as you can tell, it's about a 4.12% current yield. The portfolio as a whole has an annual total return of 35.73% so far. Since the portfolio has been in existence for nearly 15 months, that return will likely fluctuate a lot more than the returns of our dividend growth stock portfolio, which has existed for about 2 3/4 years. Currently, the high yield portfolio's dividend yield is 4.12%. But the companies in it likely will not grow their dividends as much as the stocks in our dividend growth stock portfolio. Therefore, this portfolio would be more geared toward investors closer to retirement. Having said that, many stocks in the portfolio have increased their dividends, pushing the portfolio's yield based on the amount we've invested to 5.04%. Now, 2 strategies are being implemented in this portfolio, as you'll see in the next few slides. Strategy 1 emphasizes a high dividend yield over dividend growth. Strategy 2 also features stocks paying higher dividend yields, but places a bit more emphasis on recent dividend growth than Strategy 1 in an attempt to try to get the best of both worlds, that being both a high yield and dividend growth. Strategy 2 has been the better performer so far. The average return And the average investment in strategy 2 has provided a total return of 21.4% and has been held for an average of 185 days so far, which is an annualized return of 46.64% using Excel's rate function. Now, it's not likely that the portfolio can keep up an annual return that high since stocks historically average 9 to 10% per year. On this slide, we're looking at the high-yield dividend-paying stocks we bought last week. And because the high-yield stock portfolio currently lacks any technology stocks, for those that want to add diversification to this portfolio, I added to my site a list of technology-focused investments that provide income with yields from less than 2%, like Microsoft, to yields as high as 10 to 12%, all of which I either currently invest in or have invested in. I'll also tell you which is my favorite. Of course, that technology-focused investments with the higher yields, those around 10 to 12%, do not have the chance to grow their distribution yields as fast as a company like Microsoft or Broadcom. There's always a trade-off. One thing that's different about this higher yield strategy versus our dividend growth strategy on the previous slides is we only purchase 8 stocks each week, and we have 2 different strategies, so that's 4 stocks per strategy. Strategy 1 emphasizes a high dividend yield over dividend growth. That's perfect for investors in retirement or getting close. Strategy 2 still emphasizes high dividend yields, but places a bit more emphasis on recent dividend growth in an attempt to try to get the best of both worlds. Because there are 2 different strategies, we have 4 stocks in strategy 1 and 4 stocks in strategy 2, giving us 2 rankings. So each week we take $12.50 and split it between the 8 stocks. So each stock gets a 1/8 weighting. Now, having 2 strategies within one portfolio also means that a stock could appear in both strategy 1 and strategy 2 in the same week. If that's the case, instead of the stock getting a 1/8 weighting, they get 2/8, which is 1/4, which is equivalent to 25% of that week's investment. Both strategies still only invest in high-quality stocks, meaning a quality rating of B- or better. The 4 high-yield stocks we bought last week while implementing strategy 1 are Bristol-Myers, Lyondell, CVS Health, and Chevron. And the 4 high-yield stocks we bought last week while implementing strategy 2 in green are Lyondell, PNC Financial, HF Sinclair, and CVS. This last week's purchases have an average yield of 4.9%, with Lyondell coming in at the highest with a 6.2% yield. And here's a look at last Monday's ratings for competitive advantages, management, and financial health. And on this slide, we can see last Monday's grade for recent dividend growth and current yield, as well as recent dividend growth history. And in the last column, you can see the grades for dividend growth potential, which will be much lower than the stocks in our dividend growth stock portfolio, which consists of stocks with usually lower yields, but a greater potential for excellent future growth in those dividend payouts. And here are our trade confirmations from last Monday for the high yield stock portfolio. We took the weekly deposit plus any dividends that had recently been received and then combined that and invested into those 8 stocks that were on the previous slides. As you can see, we split them evenly as much as possible. Now let's talk about our 2 technology stock portfolios. Because my students love technology stocks as well as crypto and options, we started 2 technology portfolios just for fun. For the first one, on January 1st of this year, I funded a Fidelity account with $1,000, and we invested it into only stocks offering products or services involved with certain technology themes. Unlike our other portfolios, we are not investing additional funds each week into this portfolio. We're sticking with the original $1,000 investment and see how much it can grow to. The tech themes we built the portfolio around so far are artificial intelligence, cloud computing, software as a service, cybersecurity, and big data. The portfolio can invest in sectors outside of the technology sector as long as the company is connected to one or more of our technology themes. For example, both Meta Platforms and Google are in the portfolio but are both part of the communications sector, not the technology sector. So far, the portfolio has a gain of 36.8% in a little over 10 months. In comparison, technology ETF with a ticker symbol XLK is up 23.9% over the same time period. The S&P 500 is up 27%. Best performers in the portfolio so far are NVIDIA, 206.6%, Meta Platforms, Broadcom, SAP, Fortinet, Pure Storage, and ServiceNow. Now let's talk about our best performing portfolio so far on an annualized basis. So back in late April of this year, we started a portfolio that only invests in stocks that are officially in the technology sector. Like the other portfolios, we invest $12.50 each week into it and then boost that investment annually by the rate of inflation. So we've not boosted it yet because this is the first year. Now I hesitate to call this a portfolio since the limit is to only one sector, but it has been fun to follow. Since this portfolio started, it has outperformed the two dividend portfolios over the same time period. Tech stocks got crushed 2 weeks ago, but last week the portfolio as a whole was up 6.2%, just last week. Obviously, the volatility in tech stocks has been extreme, once again showing the advantage of lower volatility strategies such as dividend investing for people who cannot stomach such large swings up and down. Now, some people are okay with volatility, some people are not. So it all depends on your risk tolerance. So how is this portfolio different from the $1,000 tech portfolio shown on the previous slide? The portfolio on the previous slide is based on certain technology themes and therefore includes some stocks that are not technically in the technology sector, like Google and Amazon. So on this slide, I rate the top stocks for the week, but they must be in the technology sector. The average investment so far has been held for 95.6 days and has produced an average return of 12.08%. Using Excel's rate function, that's an annualized return of 54.62%. If we'd instead invest our weekly investment into the ETF with the ticker symbol XLK, a technology ETF, instead of a 12.08% average return, we'd get an average return of 7.76% over this, or with the same holding period. And that's an annualized return of 33.05%. The portfolio is also outperforming the S&P 500, but remember, the volatility of this portfolio is extremely high, so it's not for the faint of heart. Note that all these stocks are high quality, meaning they must have a quality ranking of B- or better. Also note that the ranking system used here for tech stocks may differ from the rankings we use to rate dividend growth stocks because many tech stocks do not pay dividends. Therefore, in this ranking, we ignore the criteria that involves dividend growth, dividend payout ratio, etc. But we use the valuation methodology we discuss in class that can be used on all large stocks, whether they pay a dividend or not. So our 4 top-rated technology stocks last week were ASML, Adobe, NICE, and Applied Materials. So in the comments, let me know if you have any questions, and also let me know what other kind of investing videos you'd like to see. Finally, here are the places you can reach me: YouTube, obviously, as well as my website, beatthestockmarket.com, LinkedIn, and Twitter. Remember, you can now find both the dividend growth stock portfolio and the high yield stock portfolio on beatthestockmarket.com with real-time transaction data on Mondays when we make our weekly investment and anytime we sell a stock, as well as information about portfolio holdings. I'll see you again next week with a list of stocks we will have purchased on Monday. See ya!